The amount of information moving markets is overwhelming. It's very well known that the Fed, economic growth, inflation, China stress, energy prices, real rates, the dollar, and all sorts of other key macro variables impact asset prices. If you take all this data together, it's a noisy and tangled mess of correlations. The human brain has absolutely no chance of parallel processing all this information and figuring out how it's connected. This leads to an over-reliance on educated guesswork, fueled by conflicting and subjective opinions on what's really impacting markets. Quantifying macro is difficult, but we've developed a solution to solve the three key challenges and issues everyone faces. Number one, the data problem. Real GDP and inflation come out once a month or quarterly, and by the time you get the data, it's already out of date. That's why we partnered with Nowcasting, which supplies daily real GDP estimates for 20 countries. For inflation, we use inflation expectations markets across the curve that update daily and intraday. We have data for quantitative easing and tightening expectations, banking sector stress, emerging market sovereign risk, and much more. Every thematically important macro variable that can be measured is there. We have curated a comprehensive and complete set of daily and indeed intraday updating macro factors that is comprehensive and with 14 years of daily history for everything. Number two, data is all correlated. The problem is that existing models assume macro factors are independent, but this doesn't work as macro data is, as we know, quite highly correlated. The solution is that QI decorrelates or orthogonalizes all the macro data first. Only once this has been done can we then run useful and rigorous analysis. Third, the data is often not stationary. The problem here is that when data has a lot of trend in it and lots of unrelated things are trending for long periods of time, most analytics will tell you they are closely related. But what's being picked up is the trend element. So QI ensures all the data is stationary first. Now that we have all the curated, cleaned, high-frequency data, how do we connect it to asset price movements? Step one is taking all the macro data and boiling it down to what we call a macro signal using a well-known technique called principal component analysis. This converts this into this. One way to think about this is to imagine a sort of three-dimensional ribbon or plane sitting inside all that noisy data. PCA finds the underlying pattern in all that chaos. So what we're left with then is this macro signal, which comes from running PCA on all of this normalized macro data and asset price. The big question now is, how is the asset price related to this macro signal? The last and most important bit of maths is as follows. We get a confidence number out of this equation. This tells us how strong the relationship is over the last 12 months between the asset price and the macro signal. Now for our final trick, we deal with one more issue, and that is figuring out what these principal components actually mean. We know the macro signal is related to the asset price in some way from this equation, but what about taking it back to the influence of each individual factor, such as real GDP growth or inflation? We apply what is known as sensitivity analysis to this core equation. Remember that each principal component is just a weighted function of each factor. So if we take a single factor, such as inflation, within PC1, 2, and 3, and shift that factor higher, then we will see the impact on the asset price from just moving that factor. This allows us to extract the sensitivity of the asset to a move in each factor. It is also worth noting that this equation also gives us the price of the asset that's consistent with all the current information, or what we call the macro warranted fair value. If the actual price of the asset is very different from the macro warranted fair value, then that may have some implications for trading and investing. To run this entire process, we do need to convert all the data to the same units first. Often in finance, that means converting everything to percentage changes or returns. So when you look at equity factor models, for example, they convert a stock price history into a history of rolling percentage returns. Then they try and figure out what is driving those returns. However, unlike stock prices, macro data can have negative values. We saw real GDP hit deeply negative values over the COVID crisis, as did inflation expectations. And you can't calculate a percentage change when something goes from positive to negative or the other way around. Therefore, we normalize all the data in a different way. We turn it all into standard deviations from trend, or z-scores. One of the benefits of all this is that it takes all the trend out of the data. The technical term is that it makes all the data stationary. In short, take an asset price, take all the macro data, normalize all the macro data by turning it into z-scores that are also stationary. Decorrelate all the macro data or orthogonalize it and turn it into what we call the macro signal. Quantify the relationship between the asset price and the macro signal as per our core equation. Extract the relationship between the asset and each macro factor using sensitivity analysis. Just to show how the theory comes to life, we'll take a look at a quick example. Here we see the S&P 500 model. The R squared of the core equation we saw earlier is 74%. We also call it the model confidence. The macro warranted model value is 45.79. The actual price is 1.17 standard deviations below the model value or macro warranted value. We can also see the macro DNA of the asset. The pie chart breaks down the S&P 500 into its macro pieces. One can also see the impact or independent beta of each factor to the S&P 500. This bar chart shows the impact of a shift higher in each factor on the S&P 500 in percentage terms, holding all other factors constant.